Dennis just came back to Louisiana, by the way. Dennis was in Paris, France, for the past few days on a conference, and he mentioned that the whole panel yesterday was trying through 45 minutes to sort out the how. So the why in tokenization today is pretty well answered and covered, but the how is not yet properly answered and covered in all its aspects because people are trying to fix the challenges in the how, and there's plenty of them. So what Dennis said is they tried in 45 minutes to fix what we fixed in 2 to 4 years. And thankfully, we fixed it. On another block chat, welcome Denis Petrovcic and Makram Hani, and I hope that you will enjoy this one. By the way, as we promised, this is a follow-up on the previous one, which we've done, which talked about a prospect of ours, which hopefully is nearing materialization more so every day. But things are falling into place the right way. The same subject was a discussion yesterday at the forum that Denis was at. Denis Petrovcic, how are you?
Oh, very well. Good to be home. Very good. But as you might think, Makram, when you go to these conferences, you're basically stuck in a hotel for 2 days. So people are like, "Hey, how was Paris?" But I did, however,
What
have a
I've seen
chance to
of it
catch
was
up.
amazing.
Yeah. It was an amazing hotel. Actually, it was in the Intercontinental, huge old building from the Napoleon times. Very beautiful and very diverse clientele on the GRI event. I was there representing Fibri. So there was a partnership that Fibri and GRI did, and they asked me to moderate the panel there on the subject of tokenization, and it was an amazing discussion. Thankfully, I was able to moderate in a way that we didn't end up solving the how for 45 minutes. So we did as well touch up different subject, and it was great to see like the prime players and the people from the European real estate market also having an understanding, a quite high level understanding of decentralized finance. So we talked about decentralization, the importance of it, the DAOs that are emerging, so the importance of DAOs. We talked about the metaverse and kind of went through a couple of misconceptions about the metaverse as well. And we talked about the why besides the how of tokenization. But like you mentioned, is with the how, it's a lot of times the technical part is not really being challenged so much. The how on the technical side, there's companies like Blocksquare and some others that are solving the how on the technical side. What people a lot of times think is that they need to solve the how on the legal side as well. Now with us, we solve that part, and I think we solve it in a very innovative way. But through that discussion, we kind of understood that there's kind of two paths where real estate tokenization will probably end up going, and probably simultaneously. Our bet is that the DeFi direction is the one that will grow way faster than the kind of corporate path, let's say. And I'm calling it the corporate path because that one relies on established securities laws that are in place and is tokenizing traditional securities. Basically, if we simplify, we create debt or equity and we tokenize it. So the tokens actually represent, let's say, shares in a SPV company.
So,
And this,
so here,
yeah,
this is major. So I would like to just to make it
yeah,
clearer and more understandable to people. There is several frameworks, modules, approaches to fixing the how. And the how, when we talk about how here, it's the framework, it's the way it's done, it's the process, it's the methodology. And in my view, and I believe we've talked about this plenty of times, that's very important because there's plenty of parties that are sitting around the table. And as Dennis mentioned a second ago, the tech is well covered. There's plenty of parties that are covering the tech. Now, we believe that we have the how fixed in an amazing way. There's other parties who have tech fixed, or sorry, the how fixed in a different way, the how from a framework point of view. So what Dennis will talk about here is the ways to fix the how. And the first way is the securitization, what Dennis have mentioned a second ago, isn't it? So what are the ways? Let's start with that, if you don't mind. What are the ways that the how is fixed usually with?
Okay, I'll just make it really, really simple so we don't go in the details, but just in the concept of it. And I'm not a lawyer. So, if you would ask a lawyer, it would be, again, if you would be talking with Peter about how to tokenize equity, that's, again, a new block chat, basically, just on that.
Actually, there is block chats, so like with Simon, like with Daniel, that covered that from a taxation perspective, as well as from and with Peter as well. So, perfect. And we've talked to enough lawyers, so you probably can talk of it as much as a lawyer.
Well, I did have the first year or two, I would say, a lot of talks with lawyers, and we were examining the how in different ways. And how this usually happens is the lawyers, there's creative lawyers. I'm not saying that there's a lot of creativity in being a lawyer, definitely. But it's us entrepreneurs who are challenging lawyers with solutions, and they're discrediting those solutions then. Until you come with a solution where they are like, oh, this really makes sense. And how we fix the how with the corporate resolution, it's the solution that makes sense to many lawyers. Now, if we go back to the tokenization of traditional securities,
the ways to fix the how.
Number one,
first,
right? So there was the ICOs, and then they said, hey, tokens can be actually securities. We can do tokenized debt, right? So next boom is going to be the security token offerings market. And guess what? Nothing happened. And there's a reason why nothing happened. So if you go and dig into the why, is because everybody needed to wait for regulators to catch up. Now, today, you have 3 jurisdictions in Europe where you can do that. And one is not in Europe, it's Switzerland. One is Luxembourg, and one is Liechtenstein. And guess what? All those 3 lawyers are the most expensive. So every time you do something like that there, it's going to cost you a lot of money. It's not going to be cheap because every time it's going to be a bit different. So that brings the cost up. And it might be great when you do a 100 million deal and put it on the table. But on the other side, there's not many 100 million deals that were done in the past. So the track record is thin or non-existent. So you have this issue of, bootstrapping, if you want to say, right? The process. At the same time, by doing so, you're immediately canceling out secondary market liquidity potential because it's reliant on centralized exchanges that need to have the license to trade securities. It's not that simple. It's way easier to launch a cryptocurrency exchange than a securities exchange. Why? Because that's the privilege of the London Stock Exchange, the New York Stock Exchange, etc. There's a couple of companies that went into that direction, mainly in the US, and were able to kind of create a new type of stock exchange, right? And gain those licenses. So again, the US is a bit more open about this
granting that privilege.
Exactly. But again, it's a centralized privilege. So you've tokenized it, and now if you want to ripe the fruits of it, you need to get approval or get listed on that kind of exchange. So if that exchange exists or not, it's your you are dependent, let's say. Okay. Now, Why is this so? Because there's regulation in place for hundreds of years, regulating and evolved into regulating traditional securities. Now, option number two, let's just stick with these two options because I
There's
think
plenty
it's the
other
key.
of others, but those are the most common.
Yes.
And by the
Now,
way,
option
there's
one,
some people
yeah,
who like what we do, but still think that what we do is the first option. And there was someone who talked about that a few days ago on a forum,
mm-hmm.
and then we needed to thank him for liking
Yeah,
what we do in general and noticing it, but at the same time correcting
mm-hmm.
the how that we do.
Yeah,
So the
and
second way.
the second way is the one that we kind of found or discovered in a way through the conversations with many lawyers. And there's, top paid lawyers in certain countries that we talk with. So the other option is to tokenize economic rights. And a lot of times it's like, oh, so this is a security. In many markets, this token is a security. It's definitely an investment through the token represents an investment, and it can create dividends for whoever holds it, right? And because it's attached to a physical asset, there's a physical or an actual company backing it, behind it. And it means that it does fall under certain regulatory confinements like AML, right? But
Exactly.
what happens is you're not tokenizing a traditional security. And I think this is key. So you're entering or creating an unregulated market that will require regulation once it's big enough and it receives attention. It will be regulated, but it will be regulated in a new way. It will take
Non-regulated but fully compliant. So this is
exactly
very important. We
non-regulated,
always say it.
but fully compliant. And if you ask Daniel, for instance, who's assessing risk and creating the risk assessment framework for, and hopefully we'll have him on a block chat soon, he's always mentioning, and any investor knows this, you have US treasuries is like the benchmark of the lowest yield. And then you have risk adjusted yields based on appetite of investors, right? And what we've created is a token that's attached to a physical asset and its economic value, both the value of the asset and the revenues. And it has a bit higher risk probably than, let's say, holding a tokenized share of a company. So it's not equal, but it's definitely not to be discredited. So the risk is a bit higher. But if you compare it to a crypto asset that's backed by community and that's it, the risk is way, way, way lower,
Let's
right?
identify here the risks because I believe that's major. So let me
Yeah,
intervene to identify the risks. So here, what Dennis is talking about, guys, is a risk in the probable results or risk in achieving the probable result. And let's talk about that. So when you tokenize and you use what we use, the corporate resolution to tokenize economic rights, and we will talk about it in detail today, what you're having as a risk is the following. And this is very important. And by the way, we discussed it with lawyers before because it's very important that not only do we identify it, we mitigate it. And this is what we do alongside Daniel in our asset onboarding meeting every week. We talk about that. Guys, when you tokenize using a corporate resolution, if the party who holds the deed, the title, commits a fraud, because that's what it is, and does not really commit to the agreement they've signed, it can be pursued in court. So the risk is the legal cost that comes with it. His risk is the legal liability. And it's not a trip to the park to have fraud committed when you own a property that you've signed an agreement giving away the economic rights of the property with or in. So that's the risk. Just for people to understand, it's not a tokens risk. It's not a technology risk. It's not a legal risk. The risk is that if the party who committed at the other side of the transaction, which can happen today if you're buying a property in a conventional manner, you go, you pay your deposit, the other party pulls back. If the other party does not have a deposit in, which is the case in most jurisdictions, you would need to go sue to be able to get a court order to block the unit, the property, and to collect your probable penalty, which may be 10% if it's 10% that you've put, or additional damages if you can prove that. So it's exactly the same. There's a contractual agreement being signed with the owner, holder of title, where he commits to that. That's the risk. Just to be clear about the risk, because that's very important. Yeah. There's no other risks that are related to this transaction that are not found in every other transaction. I needed to intervene with that to explain that.
It was perfect that you did. You mentioned one thing, it's fraud, right? And we all know that fraud is one of the highest, or it's a very high penalty, I would say. People get in jail for fraud.
It's a criminal offense. It's not a civil offense.
Exactly. So I mean, I'm not a criminal lawyer. My wife is a criminal, or used to be a criminal lawyer. So when we speak about what I do as well, right? But and she helped out in formulating the corporate resolution as well. So there's a lot of her knowledge in that template we've created, right? The penalty, it can get you to jail. It's not just monetary, right? It really depends on the size and how many people you screw over. But let's go into the real estate tokenization. You have 1,000 token holders. I'm sure that if there's significant value in that claim, there's going to be lawyers representing the whole.
That's the beauty of
the
it.
Whole pile of token holders, right? And that's enough power to push somebody to say, hey, I'd rather pay back my debts to my to my creditors in a way, because it can be regarded as, in a way, as a line of credit in a way, even though it doesn't need to have a repayment date, but it has a repayment event, let's say, right?
So and here it's very important. If you were the only party in a conventional transaction who's doing that, you need to pay the costs of the legal fees. And the beauty of collaborative economies, if you are 100 or 1,000 or 10,000 people and each owns 10 tokens, the cost of a legal battle that may be $10,000, $5,000, $15,000, whatever it is, wherever you are, is borne by each of you in an effect of $2 to $10 per party. He needs to pay it all. So it's much more painful for him. And this is when I talk about risk mitigation. We mitigate risk within our process. And we will talk about the process very briefly, if you don't mind, Denis, here. How do we accept that? How do we sign a corporate resolution? What should we have of the property? And then we'll go into the legalities and the how of it. However, we mitigate it through the process, but it's also mitigated by the nature of the beast. And the nature of the beast here is that if the 1,000 or 2,000 token holders want to have a case against the owner of that asset, the title holder, the party who committed to that tokenization event, it's simple. It will cost you $10 each, while it will cost him $10,000, $15,000, $20,000 to have the same battle as you. Which side of the table would you like to be on? So, Denis, let's talk, if you don't mind, your You're trying. I noticed you were trying to change it and it wasn't working. So
No, I remember that I don't have my phone, which I use for the camera, for
that's
on airplane or airplane mode, and I was like, oh, I'm gonna get a call sooner or later, so I just disconnected.
so here, and by the way, I wanted to mention something while you were saying it, but then I didn't want to cut the
Yeah,
ideas, the screen of
yeah.
thought. The two people you want to never get married to, a criminal lawyer or a criminal detective. And, and it no, look, it's easier when you say it used to be her career, not anymore. So, so
No, she
that's
said
probably part of the agreement.
she's
So to go
well,
back to
she's way too my wife, she's way too nice to be a criminal lawyer. But she loved it. It's yeah, she was really good at it. Um,
okay.
but yeah,
So today, if we want to, Dennis, say we've 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 mitigated that by the nature of the beast. Can we talk,
Mhm.
please, about the process, and then we start
Yeah,
talking about the corporate resolution, which is a major thing.
yeah, sure. So so the process is basically on the tech side, or on the legal side, let's say, the process is the property needs to be owned by an LLC, just like with when you tokenize shares, that's the same deal. But here, the shareholders execute a corporate resolution, which is a decision by the shareholders to transfer any and all economic rights to token holders based on how much tokens the token holder holds. And it's a unilaterally signed contract where the appropriate people within a company are signing it. And then this resolution is uploaded to IPFS, where it's basically available for anybody to access. And from a technical perspective, this means that the document, after it's signed, it receives a unique hash, so it becomes uniquely identifiable, and it's registered then in the token contract that's created prior to the signing of the resolution, so that the resolution also holds the information on the token contract hash, so the address, which is also unique, right? And so then the hash of the document is registered in the smart contract, and the smart contract is referenced in the legal document, so they work jointly, right? Now, the beauty of using it from a usage perspective is that, you know, many times properties are already held on LLCs, and you don't need to restructure that LLC, or you don't need to transfer the title from that LLC to a new one, which in the case of tokenizing traditional securities, so shares of the SPV, it's exactly the case. You need to restructure the incorporation documents of that LLC. Well, here you just add a resolution that kind of transfers the economic rights. So it's way easier, it's way cheaper to do from a legal perspective. It can be templated. There's minimum due diligence that needs to be done, and it simplifies the process. At the same time,
And
it creates a token which is not a share, and many people who are in the crypto market and in DeFi, etc., know that tokens are way more than just shares, because a share, there's not much you should be able to do with it. There's, you know, it's created for a specific case to define how much of a company you own, and how much of the dividends are yours. You know, the dividends are paid usually in terms of profits, right, and not in terms of revenue. So you can't really say, hey, here's a share of this SPV that holds title to this property, and however we manage it, you know, you still get a share of the revenues. And if we mismanage it, and if we, you know, if we are, you know, cooking the books a bit, you know,
we don't
you are
execute.
not affected. You're not affected. But if I'm a shareholder, you know, if I invest in a business where the director of that business is, you know, burning a lot of cash, there's no dividends in the end for me. and I'm holding, and that can happen with property because you can invest a lot of money into renovation, etc. And sometimes this is good, and sometimes it's better to keep it more on the cash flow side. So not eat up the revenues and create zero profit. So there's differences, obviously, and I believe that through the resolution, you are basically senior in terms of debt repayment, or if there's a default on a loan somewhere, that bank debt is going to be serviced first, and then the token holders come into play, and then the shareholders are last. While if I'm a holder of a token that's a share in the company, I'm basically a shareholder. So I go in the last tranche
And this is
with
major.
everybody else, and that's major difference.
Yes.
That's a
It's
major.
in the
People don't
case of a
understand it.
foreclosure.
People don't. Let's put it in numbers. Probably you can do it easier. We have, let's say, a 1 million property. There's 500,000 debt outstanding. There's a default by, I don't know why, but it happens. And the bank needs to get 500,000. The property is sold, let's say, for 700K undervalue because there's a push to do it. In many jurisdictions, there's a process which is a bidding process, right? And sometimes the market just not. Usually, when shit happens, it's the conditions are different. There's always people that want to buy into it, but
So here, by the way, this is major for two reasons, Dennis. One, guys, in general, when foreclosure happens, it's because property price have been dropping, thus rentals, returns, and many others. Economy is not doing well. Owner is not able to service it. Yes, foreclosure sometimes happens in an upmarket with different scenarios. However, in general, when there is proper equity, an owner can easily sell on the market, pay off his loan, and move on from there. In general, foreclosures happens at that time. And most of the time, banks pull that blanket of the borrower when the value approximately approaches the debt. So let's say you hold a security token or a share, you're a shareholder, and there is a 50% loan to value, bank loan. There is 20% or 10% tokenized. And by the way, with Ocean Point, for example, what we're tokenizing is 10%, and maybe Ocean Point will buy 2 or 3% of the property, not even more. Yeah. And that's a different subject we'll talk about in a different session. Actually, maybe this is something that we should follow up on in a different session separately. We've touched on before, but it needs probably a proper session. So let's say the property prices drop by 35%. So the total value of the 1 million property now is 65. It sells slightly below that. So let's say it sells at 62% of its original value, thus slightly discounted from the current market price. Bank gets approximately his money, or actually his money. Some costs go for the process. If you are a token holder and there's 10% tokenized, you get your full money. Now, if you are a shareholder, a security token holder, what would you get? What would you get, Dennis, in that case?
Nothing. Zero.
But you still have the token, yeah? It's great. Unfortunately, you get nothing.
But the thing is, it's different markets have different kind of rules of how this is done, right? For instance, in Slovenia, and I bet it's similar in markets in Europe, there's basically this bidding. It's basically an auction, right? It goes into an auction, and then whatever is received, the mass
is distributed.
It's received, that goes for repaying
based on seniority.
Exactly. So the bank gets paid first, and then everybody else, right? And the last is always the equity holders. That's like the last is there.
This is the first benefit, or the first major benefit. There's a second major benefit, which is today, if you tokenize and through the regular conventional method, that generally followed method, not through the method that we've created and we follow as Blocksquare. And by the way, we didn't create it. we got it to tokenization, but this method is a contractual agreement that is done currently between companies all over the world, between publicly listed entities, between government entities and companies. So we didn't create those contracts. We didn't create a corporate resolution. It's available since hundreds of years. We just got that method into tokenization. We've created that and the framework around it and how is it done, which is very important. It's as important, if not more important, than the tech and everything else, because the tech is a tool. Everything else is tools. The methodology is what makes all of those tools talk to each other and the market right. However, there is a very important thing over here. I tokenized in a conventional manner of tokenization, if we can call anything in tokenization conventional. I tokenize and securitize. I created security tokens. The slabs and the layers of cost usually equate to the same or sometimes more than the layers of cost when you're crowdfunding, isn't it?
Yeah, probably.
And
Yes,
this is one of the caveats, because it makes it less feasible to tokenize. Because if you're adding a layer of cost on a $100,000 property or a $70,000 property,
somebody needs to
and
pay
that
for
layer
it,
of
right?
cost, sorry?
Somebody needs to pay for it. That's what you're getting into, right?
And that cost, let it be $20,000.
Yeah.
And the property you bought was at valuation, $70,000. You added $20,000. It's immediately overvalued by around 30%. So you overpaid around 30%, not because you overpaid, not because somebody sold you something wrong. Crowdfunding guys are not doing anything wrong, but there's a cost. Someone should pay it. They need to make a profit. Who will pay it?
That's which makes it feasible for larger assets, right?
Yeah.
Because then this is absorbed and the percentage is way lower, right?
100%.
Yeah.
So I think this is the second benefit, which is very important. Let's go to the corporate resolution and talk more about these. What does it have in it? What does it consist of? Because yes, people know corporate resolutions, but what would a corporate resolution that we use to tokenize the economic rights in an asset represent, and what does it hold in its clauses?
Now, before we start digging into it, we'll share the screen as well, and then go just show how the resolution is structured. Just to emphasize, we have the resolution translated in 8 different languages so far, and it's openly available on our docs.
Can we mention the languages?
Anybody can go to docs.blocksquare.io and find the resolution there. There's a PDF
and copy our method.
You can copy it. It's fine. Like,
so there's Arabic.
Look, the real estate market is so huge that the more a method becomes standard, the larger the chance for us to be successful,
to be mainstream.
Exactly. So we are championing the use of a corporate resolution for tokenization of real estate assets. We're the first one to do it, and we will always be the first ones that have used it. But if I get, I don't know, Skanska,
we don't want to be the last ones to use it.
If I get Skanska to use it, that's great. If there's I don't know, JLL using it, that's awesome, right? So it's there. It's openly available.
It's there.
We've created it, but it's there. It's something that we just can't. We can't put a patent.
We don't want to make it exclusive.
We can't patent this.
It's actually, and that's why we share it,
because it's not. We didn't invent anything. We didn't invent tokens, and we didn't invent a corporate resolution, and we didn't invent the articles that are there. We just combined it so that it works for the tokenization of real estate, and it's unpatentable. So it's open source. So it's there. Like, if we don't publish a template on our docs, anybody can go to any tokenized real estate asset and find it.
Yep. It's available in Arabic?
Yeah. It's
English?
Available in... let me check. So Arabic, Dutch, Hungarian, Polish, Portuguese, Spanish, and Slovene, and the English only version as well. Yeah. So that's for now. But
So whoever you are, most probably will be able to read
German
it.
is, I think we already done German as well, but I don't think it's in the list on
Published.
the docs yet, updated. But yeah.
So what does it hold within it? What does it do?
So let me just share here the screen, and we can take it from there, right?
Mm-hmm.
So main part of the resolution, we went into the direction of creating a legal document that's simple to read. Why? Because tokenization is meant for the retail investor ultimately, and anybody needs to be able to read through it, and any lawyer should be able to read through it and understand it. So it's a short document, 3 pages for now. We're currently, I need to emphasize another thing. We're currently at version 1.2 of that resolution. And which means we believe, our legal team, that this is an iterative process, and that in different markets, we might see a different path, like a fork of that resolution happening, because there might be certain things or certain laws that are specific to that country that require specific articles to be added or subtracted, probably added to the resolution. But right now, this is the base, right? And so it has, on the upper side, it has the header with the information on the company that is tokenizing the property, that owns the property, or owns rights to the property, with the shareholders being listed that are signing the resolution. So there might be one shareholder, or there might be many, right, who need to sign it off. So there might be a board, or it depends on the complexity of the LLC structure. Then secondly, there's the section where the subject matter is basically identified. So what is the asset that is being tokenized? So certain parameters are defined on the first page. So we know exactly which property we're talking about. There might be multiple properties under the same token as well. So that is identified. The location of the asset, the functionality of the asset, as well as parameters like share of revenues, and the buyback threshold. And then there's the second part, which is composed right now out of 7 articles that compose the rules of the game. And these rules basically define the obligations of the issuer towards token holders, as well as the rights that token holders receive. And they talk about revenues as the recurring, let's say, cash flows that the asset is producing, as well as a buyback obligation. And a lot of times I'm like, oh, but this talks only about revenues, but it doesn't talk about the asset's value. And the thing is that the buyback is actually the one that defines the asset value, because the value of the asset needs to be, yes.
And let's explain it here. So, and if we can talk, please, about why is there a buyback obligation? And the buyback obligation is to, whenever somebody wants to sell the asset and you've tokenized it, how does it happen? And what is enacted over there? And what is distributed? And what are the options? Because there's a variety of options for the offerer, the initial tokenizing party, the initial title holder, as well as several options that the market may accept or not accept.
Yes. So on the offer at which the issuer is offering the token, it's the one that sets the valuation at first, right? There's an asset valuation that's usually backing the offering price. And if there's too much of a difference, there's probably not enough incentive for people to buy into that asset. If I have an asset in a market and that property is valued 1 million, and I want to sell it for 1.4 million valuation, and the revenues are still the same, which means the returns are way lower, right? So I'm diminishing returns for the investors because of it. There's markets where this is possible, and there's markets where this is just not feasible, right? So we define in the resolution the bottom line. So whatever price I'm selling tokens for, that's my buyback obligation. I need to buy back tokens for the same at the same valuation, at the same price. I sold them for $10 per token. My obligation is to buy them back for $10 per token. Some property owners say, hey, but what if the market goes down? Yes, it's your decision as the issuer of a token that you assess your entry point. And you need to carefully assess this because it's an obligation at the time, right? So this incentivizes asset owners to issue the token at the right valuation instead of a higher one, because otherwise it's just okay. I issue the token at 1.5, and if things go down, I don't have any responsibility there. The market went down. People bought at the wrong time. So here it's important to get that initial offering price right. Now,
Can I explain? Can I
yes,
re-explain this if you don't mind
yes,
before we
yeah, yeah.
continue?
Go
So
ahead.
let me explain it in my way, because I'm sure that there's some people who understand it my way, and Dennis was giving you all the details, every single detail of it. But let's look at it from a real estate transactions point of view. Somebody wants to sell, it's me. Somebody wants to buy, it's Dennis. I want to tokenize and sell as tokens. Dennis will decide if he's interested in my offering or not. So I need to put out a feasible enough offering to entice Dennis to buy my token, isn't it? That's the logic about it, and that's the market game. I, as an owner, as a title holder, go out and tokenize my property. My offering can include a variety of things. One thing it can include is the whole of the revenue passed on to the parties who are the token holders. I can put in it a different term, which says that not all the revenue passes on. Obviously, if Dennis doesn't like my offering, he will dismiss it. I will put my property on the market at a certain valuation, which decides the value of the token. Now, if Dennis, as a buyer of the token, looks at the valuation, because there's an ICS certified valuer valuing the property or equivalent, valuing the property, and it's public. If he doesn't like my offering compared to the valuation, he wouldn't buy. Even if I'm offering at valuation, maybe he wants a discount to valuation. It's market dynamics again. And then Dennis buys my token. Now, in that, I set also the exit point. And I said the exit point does not have to have a date. The exit point can have, it's an exit event, as Dennis mentioned. I can say that at a certain point of time, and that certain point of time can be defined in different ways with different parameters, similar to if I find a buyer in the future who would buy at so and so, I will pay back the property value at that point of time, distributed evenly to asset holders without retaining anything. So in other words, the asset or the token holders are getting the full valuation benefit, thus the full capital growth and appreciation benefit transferred to them. There's another option which should say, if I want to buy back, I would buy back at a profit of 10% for the whole period to the token holders. Now, again, Dennis, as a buyer, may accept to buy this token or may reject to buy this token because he doesn't like it. And this is, again, market dynamics. Now, the last simple thing that we need to explain over here is you tokenized your property, Dennis wanted to buy, and you want to be lucrative, to be fair to Dennis and to be fair to yourself. So you've chosen a perfect property in a perfect location. And you say that you have the right to buy back at a certain time. Either if you're selling, maybe you say, I have the right to buy back even if I'm not selling. And that is what somebody would do if he has an amazing property, perfect location, and putting it at a discounted value, maybe from the valuation. And there's many benefits, because what he's doing is he's selling it out, but he can repurchase it in the future. And this is what he wants to do. So I have a property that's worth $10 million. I put it out at 9.5. It's a good discount. 5% is a very good discount. The buyers buy it, and I say they get the full cash flow every year, with the exception of 5%, which will go to my company that manages the property, for example. And again, I can put it out without that. And then I have the right after 5 years and beyond, for example, again, all of those can be defined, to buy back with a profit that makes Dennis's and every buyer, every token holder's annual profit at least 15%. In other words, if Dennis made 5% annually, there's 10% annually that I need to pay off now. So if I'm selling the 7th year, there is a 70% capital appreciation that I need to pay. Now, over there, it can be an obligatory buyback for me, or it can be an optional buyback. An optional buyback means that Dennis can buy it or not. Look at the variety of options, guys. It's amazing. It's just amazing how lucrative, how simple it can become, and how secure it is. Back to you, Dennis. But I needed to explain this way
No,
because
it's
I believe that people
good
think,
you
some
did.
people like me think transactional, and this is transactional.
Yeah. There's, by the way, there's a clear example of how this works in practice on the docs in the pages. Like anybody that's really wants to do this, they have all the answers there. And we even go through the process of buying back tokens. And as you said, Makram, there's the buyback by default in the template we have published. The default buyback is an event. Let's say any transaction that involves the real estate asset as identified in the first part of the resolution. And this also includes mortgaging, remortgaging the asset, right? So there's this buyback obligation that's triggered by real life events. And the buyback price is the one that creates or encapsulates the economic value of the asset. And because the economic value of the asset can be defined in so many ways, we use the simplest way of doing this, which is negotiation. And giving negotiation power to token holders. So basically, there's a parameter in the first part, which is called the buyback threshold, which defines the negotiation power of token holders. 100% value means there's no negotiation power for token holders. A 0% value means all token holders need to agree. So that the quorum on that price offer is complex, I would say, to achieve. And we discourage the market from using either one or the other value. Anything in between creates enough bargaining power or gives enough bargaining power to token holders to be able to extract a fair market valuation of the asset. But always the minimum buyback price is defined by the maximum issuance price. And that applies even through multiple tranches. So if I sold for the first time for $10 per token, and then I did another issuance for $13 per token, the $13 per token just are the floor price. And that's it.
That's
So
templated, but
exactly.
again, it
And
can be
like you
dynamic. You can
mentioned,
change it.
yeah. And like you said, there's multiple ways of how you can define it. You can say, hey, I will not have any bargaining power given to the token holders as the issuer because I have an asset that I know it's really, really amazing. And I know that in 5 years' time, it's going to appreciate X amount per year. So I'm going to reserve an option to buy back, like you said, in 5 years' time, if I'm willing to buy back at this appreciation rate, right? And that's fine. And then the investors know what they can get on the top line or on the upper level, because that's like anything beyond that, it's not going to be paid to them. But there's also this floor price that is defined by the time of issuance. It creates enough room for secondary markets to thrive as well. And that's another important factor of tokenizing through the corporate resolution as opposed to tokenizing shares. Why? Because you're not relying on a centralized, licensed third-party exchange for that to happen. But you can use smart contracts like the ones we use on our marketplaces and marketplaces of our partners, which actually had not been coded by us. The amazing part is we're using infrastructure from zerox.org, which is one of the largest providers of decentralized exchange tech infrastructure. And it's their contracts that have been used widely in DeFi and in crypto trading in a decentralized manner. There were pioneers of decentralized exchanges. And we're using those contracts to allow that exchange to happen. And this is something that can't happen when you're tokenizing traditional securities, because the exchange should not happen in that way. And then the settlement, the actual settlement of rights that comes through that exchange, or that would come through that transaction between two parties, might be even opposed in court. Here, there's no regulation, like I said, that would be able to oppose that transaction, and the regulation will form, but it will be able to form in a way for the technology that makes it happen and makes it feasible to use to be actually, part of the discussion right away.
So, one last thing before we move to dealing with the last question. Today, we're tokenizing using a corporate resolution. We made it easier, more feasible. We mitigated the risks. We identified them. We mitigate them. So that's the legal side of the how. And then there's people who are asking now, okay, I've understood the process. How will I be able to do it today? Will I be able to tokenize and launch my tokens on the market? Will I be able to tokenize and make use of my tokens while I own them? And we tell you yes. How can they make use of their tokens if they tokenize their asset today, Denis, while they still own them?
They will, with our tokenization method, the actual ownership of the full bundle of rights remains intact, right? So the title is always owned by the issuer. So that doesn't change however you do. But you create a liability on your books, basically, if you transfer tokens to a third party, right? So you create a relationship. Like, I tokenize my apartment and I sell 1,000 tokens of my apartment to you, Makram, and now we have this relationship that changed.
We don't want a relationship. So me and you, we don't want a relationship.
We don't want it, yeah.
Let me ask you a different question, or the question in a different way. How can I tokenize and make use of my tokens without selling them, without you mentioning staking? So without saying the word staking, can you explain the process of how can I make sense of tokenizing today, just because I want to test the future, without selling any tokens? I want to continue having all economic rights of my property.
Okay. So
but you can't say the word staking.
I won't say the word. Basically, it's my view is that tokenizing a property adds value to the property without the tokens being transferred to somebody else. It's like you install a fire extinguishing system and a fire escape system in your building, not because you want to have a fire, right? But because you want to be safe and you want to be future proof and things happen, right? You install new technology in the building because of that as well. And here it's kind of the same principle. Imagine the market next 12 months. Is there chances where you'll be short in liquidity? Is there things you might prepare to happen and maybe never use and hopefully never use, right? And I think that's reason enough for people to start tokenizing their assets. And there's nothing else you need to do. We will issue a smart contract with the token. We'll take you through the resolution part and we'll structure it. And you become the owner of that token contract. You are the owner of the resolution part. And by not deciding not to issue any tokens, your position is the same. You're
So the
fine.
task that I wanted you to handle was explaining staking without saying the word staking. So, so
Well,
that's the
I
difficult
understand. I understand
part. I
what you
know.
wanted to do, but I wanted to go a step before
Okay.
before earning some crypto with it, right?
Okay.
I believe just the process of doing this is already important enough. And the next step is you can, of course, use that to earn on the side extra revenues. You're not giving away any of your revenues that you're generating. It means you're just committing 10% of the value into a new emerging protocol that's being built up. And by doing that, you're becoming the shareholder of that protocol. And that's basically what we're doing here. And I don't
And what
know.
are you doing? And
Sorry,
you're earning from it. And you're earning from it.
you're earning from it. Yeah, you're
Actually,
earning.
you explained it perfectly because people ask, why are you giving me staking rewards? Where are they coming from? And that's exactly how it is. Forget about the word staking. Okay.
Oh,
This is
you
exactly what
mentioned
it
it
is.
10 times already without
I
it just
can,
means that
man.
I can't, but you're mentioning it all the time. So it must be difficult to explain staking without saying staking.
And
But thanks for the
but
challenge.
you've done it
You
very
know,
well. Look, in Arabic we say يحق للشاعر ما لا يحق لغيره. In other words, the poet is allowed to say what others can't. So I'm the poet in this instance. So man, you've explained that perfectly. People can earn rewards. You can tokenize today without selling off your economic any of your economic rights. It will cost you nothing. You're subscribing into the future, supporting the protocol, because
yeah,
obviously if we have half a billion tokenized, it's better than having 43 million, which is what we have now tokenized. And that is more value for everyone, including you, in that ecosystem. Dennis, I believe we've covered it all. Is there anything else we haven't covered today?
I think we have covered everything. I invite anybody to actually go and check out the corporate resolution. I think it's a fascinating way of tokenizing real estate value that should not be definitely not overlooked. And I think it's the future of real estate tokenization in terms of DeFi. And that the tokenization of traditional securities is going to take way longer time because it needs all those stakeholders in the process to agree on it. And Bitcoin happened not because banks started using Bitcoin, because people started using it. And so I think that's kind of an analogy there. And in terms of tokenizing real estate, why you would do it, let's put this in a different context. We never probably mentioned it before, but let's take a look at the market. So right now, there's a huge number. I don't even know how to read it, but I think it's like 9.8 billion locked into a protocol called Aave. Now, it's a crypto bear market, which means yields in DeFi protocols are hard to find. People want to keep their crypto. They don't want to sell it at they are waiting for better market conditions to come. So what to do with it, right? It's fairly cheap right now to borrow stablecoins because there's a lot of investors in stablecoins. So there's a lot of it on the market, and there's not much demand for it. Now,
And they don't want to
imagine
sell.
no. Now imagine I can take 100 ETH I have and lock them into Aave and get a loan. And then what can I do with that loan? I can actually buy a portfolio of properties that Makram and Denis owns, and they're generating 8% returns, let's say. And I can pay off the interest rate on the borrowed USDC. I can make money on top of it, and I still have 100 ETH when things get better. And this is just a thought there
Let me
of
translate that.
people thinking, who's going to buy tokenized real estate? Crypto investors. That's the answer.
Let me translate that into greed language. Let me tell you that. And you'll love that. You have ETH. You believe in it. You think it will grow in value. You think that the bear market will end very soon. You want to wait until it grows. Perfect. You're locking that ETH, losing nothing of it. It's still intact. You're borrowing against it. You're paying or you're buying cash flowing assets with it. Not only cash flowing, capital appreciating assets, inflation hedged assets with it. You're getting this return. You're paying off the cost of the debt plus part of the debt as you go. Eventually, you'll end up in a position in few years when the markets sprout again, and it always does in a way or another. And I'm not advocating here for the price growth of any cryptocurrency or any token that's not related to real estate or a real life asset. This is not what I do. So your ETH over there is back to what it was or what it should be. Maybe you think it should even be 10 times what it used to be. You have it. You paid off the debt from the income of the cash flowing asset, and you own the cash flowing asset. Cool. So imagine, let me explain that in a different way. ETH, call it gold. Now, you may like ETH more than gold or gold more than ETH. It doesn't matter. To me, I don't like gold as an investment. And I have never invested in ETH. So I'm that poor guy on the side. You have gold. It pays you nothing. You put it in your safe. Actually, it costs you money to store it. It pays you nothing. You hope that it will grow with time, with inflation, or it will grow in value. If you can, go to the bank, put it in the security box that you do put it in today, borrow against it, however, so nobody is touching it, nobody is trading it, nobody is doing anything with it. You're just putting it there, borrowing against it, buying a property with that money. You still have that asset, that gold, collecting the cash flow. Remember, gold does not cash flow usually. Yeah, the property does. Collecting that cash flow, paying off the bank, you end up with the gold that was sleeping and is still sleeping. It did nothing and didn't need to do nothing. And the property that will cash flow for until it stops. To me, forever. Think about it.
You're increasing a bit of risk, but you're distributing the risk. And right now, in terms of Web3 markets, DeFi crypto markets, there's nothing like it.
Exactly.
So there's no product there that can be said, hey, but why wouldn't I just go there? It's not there. So think about the potential liquidity that's there in DeFi markets and why tokenizing through a corporate resolution makes way more sense than anything else right now.
And for the coming few months, you still can tokenize through a corporate resolution on our account. Blocksquare is paying for your tokenization event, and this will not last forever. Very soon, you will be paying for your own tokenization event. Still, we made it very economical, so it will still make sense for you to do it then. But if it makes sense for you to do it then, why not do it now and pay nothing? Isn't it?
Yeah, we. I think here we're mentioning 43 million across 49 properties, and we already have another 4 properties we haven't confirmed in this the statistics yet, but we have confirmed internally. So things are being added, and we'll soon reach the 50 million mark. And we said we're gonna follow suit until we get 100 million worth of real estate tokenized. And then we're gonna assess what happens. Are we gonna continue doing it on our account, or we're gonna ask new property owners to at least cover the costs that are created with it?
Dennis, I believe it was a very interesting session,
Yeah.
and hopefully everyone benefited. It answered a few questions you had. It gave you some knowledge. Again, an invite for you to go on and check us out, guys. Regularly, when people are building tech or methodologies, they want to hide it. They want to keep it to themselves. We're we're an open book. You can go and check us out. You can check everything that we've said today, all what we're doing out. You can download it. You can copy it. And you can do whatever you want with it. So don't create a block circle, for example, rather than Blocksquare, but everyone is encouraged to join us in this fascinating journey. Dennis, do you want to say anything to our viewers? Actually, we went beyond. I didn't believe that it would take us this much time today, but it did.
Yeah,
But
yeah.
it's worth it, I believe. It's worth it.
Well, we touched a point, and anybody watching us today, just let us know the topics you want to discuss next time or in the future. We might not do it next time, but come to us with ideas, whether through Discord or Telegram. There's channels that we use and we monitor on a daily basis, so things don't go overlooked. Bear in mind we're still a relatively small team, so it's still, we're all fully working on different fronts with the same common goal, making Blocksquare and BST and Ocean Point successful. So thanks for watching once again, and hope you enjoyed.
He said it all. Enjoy your day.